Empires do not usually calculate their defeats. Britain had to. The Hong Kong handover was not a military loss, and it was not a diplomatic gesture. It was a financial extraction under pressure. By the 1990s, Hong Kong held hundreds of billions in assets, contracts, reserves, and foreign capital, systems operating entirely under British authority. This was not territory Britain could simply return. It was a live financial engine, whose collapse would have detonated far beyond Asia. The question was never whether Britain would leave. It was how much it would have to pay to leave without triggering a global financial shock. The danger did not originate in Beijing. It originated in a document signed in 1898, a property lease with a fixed expiration date, July 1st, 1997. That date transformed Hong Kong into a time-bound liability. The moment it was visible, markets began to adjust. Contracts, property values, and currency confidence all became conditional. The closer the deadline approached, the higher the risk of exit. Britain could not delay it. It could only manage the countdown. If continuity failed before the clock ran out, the financial system would unravel on its own. The deadline was not symbolic, it was mathematical, and it was already being priced in. Hong Kong's power was never geographic. On a map, it was small, almost insignificant, but on paper it was enormous. This was one of the densest concentrations of wealth ever assembled in a single city. Contracts written under British law. Trade financed in global currencies. Corporations headquartered in glass towers that functioned less like offices and more like vaults. Capital flowed through Hong Kong because rules were predictable. Enforcement was absolute and confidence was institutionalized. From London's perspective, this was not a colony, it was infrastructure, an offshore extension of Britain's financial reach into Asia. Profits generated here did not stay local, they moved outward, reinforcing London's role as a global financial hub. Hong Kong was the hinge between East and West, a place where money could enter China without ever touching Chinese systems. That position made it irreplaceable, and it meant that any disruption would not remain local. Pressure here would transmit instantly outward across markets that depended on its stability. By the early 1980s, the problem was no longer abstract. It was structural. Nearly every critical asset in Hong Kong rested on British authority. Property titles, business licenses, commercial contracts, the legal system itself. All of it pointed back to the Crown. That structure had worked for decades because the endpoint was assumed to be distant or irrelevant. Once negotiations with China began, that assumption collapsed. Overnight, certainty turned conditional. Why invest in assets governed by a power preparing to leave? Why sign contracts that might outlive their legal foundation? The moment the future became negotiable, risk flooded the present. Britain faced an impossible equation: maintain confidence without sovereignty, preserve value without control. If the system cracked, capital would not wait for explanations. It would relocate. And if that happened, Britain would not lose Hong Kong in 1997. It would lose it immediately, through a silent financial exit that no treaty could reverse. In 1982, the negotiations stopped being abstract and became personal. Margaret Thatcher did not walk into Beijing as a diplomat. She arrived as the Iron Lady, the woman who broke unions, crushed inflation, and ruled Britain through force of will. She was known for one thing above all else: never backing down. Thatcher believed power still lived in law. Britain controlled Hong Kong Island and Kowloon. The lease, she argued, did not cover everything. Across the table sat Deng Xiaoping, unmoved by reputation or rhetoric. Deng did not negotiate clauses. He stated facts. Hong Kong was Chinese territory. Sovereignty was not for discussion. There would be no extensions and no shared control. Thatcher came armed with legal precision. Deng came armed with inevitability. Britain could debate paperwork. China controlled the clock. And with that imbalance exposed, the real leverage narrowed to a single fragile variable: economic stability. By the mid-1980s, the shape of the deal was no longer ideological. It was transactional. Britain accepted that sovereignty was lost. The remaining question was damage control. In 1984, both sides formalized the arrangement through the Sino-British Joint Declaration. On paper, it promised continuity. Hong Kong would return to China, but its economic system would remain untouched for 50 years. Capitalism preserved, laws unchanged, markets reassured. The phrase was elegant: one country, two systems. But behind the language sat a far harsher reality. This agreement was not about generosity. It was about risk management. China wanted control without inheriting chaos. Britain wanted an exit without collapse. That balance carried a hidden cost. Stability could not be declared. It had to be financed. Britain assumed responsibility for maintaining confidence during the transition. Any panic would poison the transfer. Any shock would reduce the value of what China was set to receive. The burden fell entirely on the departing power. Britain would absorb the volatility, police the system, and guarantee order until the final day. This was not a peace treaty. It was an escrow arrangement. China received sovereignty up front. Britain paid in trust, discipline, and time. Once the agreement was signed, the pressure shifted immediately from negotiation rooms to balance sheets. The promise of continuity reassured governments, but markets responded differently. Wealth does not wait for outcomes. It anticipates them. As the future became fixed, money began to reposition quietly. Large holders did not panic. They calculated. Assets were diversified abroad. Profits were booked elsewhere. Exposure was reduced incrementally, month by month. Nothing dramatic, nothing public. But the movement was persistent. This was not protest. It was self-preservation. Every transfer reflected the same logic. If authority was changing, risk had to be reweighted. The danger was psychological. Confidence depends on the belief that everyone else will stay. Once that belief weakens, exits accelerate. The system did not need collapse to become unstable. It only needed doubt. And by the late 1980s, that doubt was measurable. Not in headlines, but in flows. Money was voting with its feet long before the final date arrived. The warning signs appeared before the handover was ever scheduled. In 1983, confidence weakened sharply, and the currency came under pressure, not because of collapse, but because uncertainty was becoming measurable. Britain responded with a blunt instrument. The Hong Kong dollar would be fixed to the United States dollar. A hard peg, no flexibility, no gradual adjustment. This was not an economic optimization. It was a defensive line. The message was simple. Stability would be enforced at any cost. From that moment forward, credibility was no longer abstract. It required reserves. Every fluctuation had to be absorbed. Every test had to be answered. The peg transformed uncertainty into obligation. Britain was now committed to defending the system mechanically, day after day, year after year. This commitment did not expire with the treaty. It extended through the entire transition period. 14 years of constant vigilance. If the peg failed, the consequences would cascade instantly. Trade contracts would unravel. Asset values would be repriced. Confidence would break all at once. Stability was no longer promised. It was being purchased continuously. This was the first real bill of the handover, not paid once, but maintained relentlessly under pressure that never fully disappeared. By 1992, the countdown was no longer theoretical. Britain sent its final administrator, Chris Patten, into a system already under strain. Patten did not arrive to negotiate sovereignty. That question was closed. His role was operational. Keep the system functioning, preserve confidence, leave nothing visibly broken. His mandate was blunt: spend what was necessary to ensure Hong Kong crossed the deadline intact. Infrastructure, governance, public services, everything had to signal continuity. But this strategy carried tension. Every investment reduced reserves. Every upgrade looked, from Beijing's perspective, like value being extracted before transfer. China accused Britain of changing the rules late, of locking in costs they would inherit. Patten saw it differently. A weakened Hong Kong would poison the handover itself. Stability had become a shared dependency, but trust was thinning. What remained was a race against time to stabilize the asset without hollowing it out. The largest fight was not over laws or elections. It was over concrete. In the early 1990s, Britain committed to replacing Kai Tak with a new global gateway, Chek Lap Kok Airport. This was not an airport. It was a concrete invoice. A man-made island built to make sure Hong Kong did not arrive in 1997, weakened, outdated, or cheap. Britain was not pouring runways. It was locking future competitiveness into the ground and steel an obligation before walking away. On paper, the project was infrastructure. In practice, it was a financial maneuver backed by guarantees, future revenue assumptions, and commitments extending beyond the handover. Britain argued the logic was unavoidable. Without a modern hub, trade would slow, capital would hesitate, and the asset China inherited would already be declining. Beijing saw the opposite risk: a departing power reshaping the balance sheet late, fixing costs that would survive the transfer. Negotiations hardened around numbers. How much could be spent? How much had to remain in reserve? The airport became a proxy ledger for the exit itself. Every delay, every approval, every poured slab signaled the same intent. Hong Kong would cross the deadline fully equipped, even if the price was paid in advance. As July 1st, 1997 arrived, the handover was framed as ceremony. Flags were lowered, anthems played, cameras focused on symbolism. But the decisive transfer happened elsewhere. Control of Hong Kong's financial machinery shifted quietly, without spectacle. There was no final payment, no closing check. The cost had already been absorbed over years of preparation. Markets opened, transactions cleared, confidence held. That absence of chaos was the outcome Britain had been paying for since the 1980s. Ownership moved, operations continued. The ledger did not reset. It simply passed to new hands, already balanced, already fortified, already priced. The real price of Hong Kong was never itemized. It did not appear as a single figure on a government ledger. With the handover, Britain forfeited an endless stream of influence embedded in daily operations. British legal defaults ceased to be automatic. Sterling's informal role in regional trade faded further. replaced by systems Britain no longer shaped. These were not dramatic losses. They did not trigger headlines or market alarms. They showed up slowly as missed opportunities and diminished reach. Once control ended, that amplification stopped. Britain exited with stability intact, but leverage gone. The handover preserved the asset for its new owner, yet stripped the former one of its long-term yield. The cost was not the money spent to protect the transition. Hong Kong was the last major financial outpost Britain still controlled outright. Losing it confirmed a shift that had been unfolding for decades. This one was calculated and expensive. Where the Suez Crisis exposed weakness abruptly, Hong Kong marked acceptance. Britain did not collapse as final. When Hong Kong passed out of British control, it closed the last chapter of a system where global finance and British authority moved together by default. Britain did not give Hong Kong away. It transferred it under pressure, paying to keep the system alive until the final second. When control expired, loyalty followed. In the modern world, power belongs to those who set the rules of money, not those who inherit history.